Morning, friends. Welcome to the Banking Friendly podcast, where finance meets friendship and where you are amigos. Join us on a journey to demystify the world of banking and elevate your financial literacy. Whether you're taking your first steps towards financial empowerment or looking to fine tune your monetary mastery, we're here to guide you with expert insights, practical tips, and a touch of camaraderie. So grab a seat, tune in, let's make sense of all this sense together.
All right. I like that. That's a great intro.
There you go. Thank you.
Yeah. Good morning. How are you?
Good morning. How's it going?
I am doing well. How about yourself?
Doing good. So y'all probably hear some voices this morning. So let's take a quick second to introduce ourselves. My name is Miranda, and I am the branch operations manager here at Texas National Bank. And with me, I have my amigo, Ray.
Yes, thank you. Yes, Ray Garcia. I am the strategic growth officer at Texas National Bank.
We are happy to be here this morning on our first episode of the Banking Friendly podcast, where we'll just talk about stuff that's happening in our environments. You know, we're located here in the Rio Grande Valley, South Texas.
That's right.
And really, as a bank, as an institution, one of our pillars, which I would think is probably our most important one, is community. And I think a big piece of that is, you know, the financial education, the financial literacy of the people here in the Rio Grande Valley.
Yeah, I mean, I think as a financial institution, we have a huge responsibility to our community, right? And it has to start with this concept, right, where we leverage our expertise as bankers, as you know, individuals with finance backgrounds, to give back financial literacy tips and you know, explain different concepts to our community to hopefully empower them and improve their overall financial well-being.
And I think at least for me and Ray, you know, we're Valley people.
That's right.
You know, we're here in the Valley. We grew up here, and I think Ray has a little bit of a different background. But for the better part of your life, been here in the Valley. I was born and raised here in the Valley, so really drawing from our personal experiences and the stuff that we've been through, the things that work, the things that don't work. You know, I think we're just all kind of learning, taking it day by day, seeing how we can, you know, better empower our financial positions.
Yes, and I think, you know, just to keep it really real, I think, you know, we're also human beings. We're normal people. We're also learning ourselves some of these, right? As we, you know, as we're just growing up, right? You know, I'm now the parent of, you know, two beautiful little girls, and I'm starting to learn a bunch of stuff, and you know, things that previously weren't on my radar that I now have to plan for and think about and be more mindful of. And I know you're right there as well, coincidentally,
yeah,
with also two beautiful
little girls, yeah, a husband, a house, a car, like just kind of all the adult things that you have to do.
That's right.
I know. It got here too fast.
It got real fast and real.
Yes. Yeah, and I think there's just some things that, you know, you plan for and you're like, okay, this is exactly how it's going to go. But, I mean, things just come up. And, like, you can try as best to have your budget and to be prepared. But then a part of it is also the willpower to, like, stay on track with those budgets and the things that you're wanting to accomplish.
Yeah, so much of this is just the discipline of it. And, you know, so here we are with, you know, business backgrounds, finance backgrounds, et cetera. And I'm still figuring it out, is I guess what I'm trying to say. So maybe I'm going to, you know, be a little vulnerable during this podcast, because that's probably not the best message to send, you know, from someone with a finance and degree and a banking background. But I think it's a reality of it, right? And again, we're all just kind of in different places and different journeys of where we're at. But I think the idea is to definitely focus on the concepts. When I think we can talk about the concepts, at least you know where to start and how, you know, the extent of how much you can do or how far you can get there, or how quickly you can get there, I think maybe dependent on several factors. But I think the important is to at least acknowledge, okay, here are the different financial literacy concepts, here are the different things that we need to focus on, and then have a clearer path in terms of how to tackle those.
And I think if you think about it, you know, really you're needing to lay a strong foundation, because there's just so much out there, like on Instagram and TikTok and Facebook. Like, you have all these people who, you know, have done their research and the things that they do for themselves, you know, the financial influencers, I guess you would say, and they're all going to have their own resources and tips and things that, you know, they say that you should do, but you have to really draw from yourself, your personal experience. And I think the only way to do that is to have a good foundation with good financial education. Just the basic concepts of saving and spending and earning power and like all those kinds of things is the only way that you can, build for your future.
Yeah, and I think it starts with at least having some sense of structure, right? So you know this, but prior to this, I come from a regulatory background, right? And we use acronyms for everything. And I think the reason why we use acronyms for everything and abbreviations for everything is because they're easy to remember, right? And I think if we can just come up with a certain structure that is memorable, So I remember we used to, look at ratings for institutions by something called a Camel's rating, right? And so every component of that was a different word, right? And so you'd always remember, okay, there's 5 pieces to this, and this is what I got to remember,
right? And
everything's down, for capital, asset quality, management, et cetera. And so I think if we can just memorialize a structure that makes sense, right? And so we took a stab at that. We started a financial wellness initiative last year, and the idea was let's first kind of broadly categorize these, and then let's dive deeper down in each one of these categories, right? So the different categories that we focused on was we first wanted to talk to our community about improving their skills and their education.
Right.
And the reason why that's important, and we've talked about this a lot as we doing financial literacy presentations in our community and talking to students, et cetera, is because there's a direct correlation with the extent of your skills and education with your ability to earn income. And I understand that there's outliers, 100% understand that. And I think that, it may vary as well. There's obviously going to be sort of one-off situations, but by and large, there is a strong, the higher your level of education or the higher level of your skill set, the greater your ability to earn. That's just, there's a direct correlation there. And so the first one we talk about is always just how to improve your skills and education and where you need to focus on that. The second thing that we talk about is then that leads to, okay, now that you have great skills, great education, well, then now you've earned the ability to earn.
You got a job.
Yeah, exactly. Make some income. And so we talk about earning power, and we talk to them. There's obviously different ways of earning. You could be a W-2 employee. You could be, you could have a side hustle. There's a lot of different side hustles out nowadays. You could be a business owner.
You get DoorDash,
self-employed.
Uber.
There's so many different ways. And then you could also have stocks, that pay out dividend income, rental income if you own rental property, et cetera. But basically earning power. And then the next concept after that is all about living within your means, right? So now that you've earned the right to earn income, you got to manage it effectively in how you spend it. And I think so spending power is a third broad category that we focus on.
I think that's the hardest one.
100%.
With everything that's at our fingertips.
Yeah.
To buy and to rebuy and Amazon and everything. So I think going back to like discipline, I mean, to me that's got to be the hardest one.
Everything is so accessible and very frictionless nowadays, right? So you go into Instagram and you now have the greatest thing that's coming out, right? And you click on 2 or 3 different next buttons, and by the time you know it, you've purchased a shirt or whatever it is.
Right.
And so very frictionless experience, and so which makes it very easy to get into debt and spend money. And so I think we need to be mindful of that, and I think especially our generation, right? I mean. It's of no surprise that us as millennials came up with the word YOLO, right? Because we want to maximize everything. We have no sense of delayed gratification. We want it now. And then when the technology is there to also help it make it very easy and convenient for us, that can lead to, quick spending that can quickly get out of hand. So we definitely want to make sure that we're always living within our means and controlling our spending. And then the next one that we always talk about is about saving and investing. Right, and I know we're going to talk a lot about that today, but that's the number one way in which we build wealth. And then we also talk to our community about things like credit and debt, which is another important pillar. And then the last one's about protecting and insuring your wealth. So I know we're going to dive down into more of all of that later, but for now I just wanted to kind of set the tone as we jump into our topic.
Yeah, and so that is a good segue into April, which is Financial Literacy Month. Started back in 2004. It was passed by the Senate, and I think even back then, financial literacy was such a new thing, was such a new topic, because even in the last 30, 40 years, there's things that have come out like the IRA. That's not something that's been around for a long time. And so we're learning in an environment that's just constantly changing. Like if we had, had this conversation 20 years ago, it would look a lot different.
That's right.
And I think it's just something that is so interesting because maybe just as people, we feel like we have to be so up to speed and up to date with everything that's going on, but it's kind of difficult when it's just changing all the time.
Yeah.
With things that I don't know a lot about, like cryptocurrency and Bitcoin and all that kind of stuff. And it's like, it's something that can feel probably really overwhelming. But, our purpose here today is just to take it back to the simple things, the simple pillars, the simple concepts that really can last you, I think, a long time.
Yeah, no, absolutely. I was trying to think about, you and I started a little mini book club here at the bank, and I was trying to think about the name of the title of the book that we read.
Oh my gosh, me too.
Okay, this is not good. I made it a point that I was going to try to remember the name of the books.
It was called Money Matters? No.
But you did touch on something. So the author does talk about how a lot of the programs that we are now, we rely on as sort of pillars of finance, right? Like the 401k, the IRA, they haven't been around for that long.
Nope.
And I remember when we read that and we talked about that, it was extremely surprising to me, right? Because here you're thinking, oh, these things must have been in place for years, right? And so everyone knows about it. But the reality is that there's probably only 1 or 2 generations back at most that have an experience with the 401k. So hence why the topic of financial literacy becomes so important, because first of all, finance is an industry that is evolving constantly. There's so many things that are being thrown at us every single day. And I think what happens is, maybe as the end consumer and just a normal human being, I think that can be a little overwhelming, and there may be a little bit of, paralysis by analysis in that, well, what do I do? What do I invest in? And what do I focus on? And so, I'm just not going to do anything, right? Because I just don't even know where to go.
Where do you start?
And I think sometimes if we just stick to the basics,
right.
Which is another great takeaway from the book, right? It was all about stick to the fundamentals.
It was The Psychology of Money.
The Psychology of Money. Thank you so much. By
Housel.
Thank you. What a great book. And so, no, I think this is why financial literacy is incredibly important. And I think, hopefully the concepts that we're going to talk about will be concepts that we can all relate to, and we'll keep it kind of close to home, focus on the issues that I think broadly affect our community. And yeah, let's dive in and talk about it.
Sure. So, and I mean, just from like my, what I do now is every Friday, and we'll get into it a little bit, but it's really easy to automate it.
Yes.
It's really easy to kind of get it going, because then that really is like out of sight, out of mind. I don't even see it. It does it on its own. There's things like, saving for the milestones and the goals, the big goals that you have, the things that, are unexpected expenses. Even paying down debt as a way to save. Like there's just a lot of ways to look at it. And I think that gives different options. One works, one doesn't work. And just like us, we're drawing from our personal experiences. So I think that anybody listening will be able to find, one way that's going to be able to help them, catapult them into, what they're trying to accomplish.
Yeah. No, I mean, this topic of savings is one that I enjoy talking about a lot because it requires a lot of discipline, right? And
it's really hard.
It is incredibly hard. And I think, especially where, again, we talked about how we've become, just consumers, right? And we're so focused on that. And there's a quote from Warren Buffett that I actually do remember. And the quote is, really, really neat. It actually talks about, it says, "Do not save what is left after spending, but spend what is left after saving."
Right.
And that is so true, right? The whole concept of pay yourself first, right? Because I think sometimes, we're focused on, okay, well, I'll transfer savings after I've gone through, my bills, my groceries, my utilities, my rent,
movies,
my all
to
that.
The mall, yeah.
That's why I went to the mall, I bought some clothes, the whole 9. And then, okay, I happen to have a little extra money, so I'll just leave it in the checking account. A lot of people don't even go through the exercise of opening up a savings account because they're just like, basically my savings account is whatever I didn't spend is in my checking account, and that is my savings account, my de facto, savings account. And I know that I think a lot of us can relate to that because it takes a lot of discipline. And what I find is that unless you come up with a strategy, a plan, most people aren't saving. And
Right.
it's I'm seeing it now as I've had parents, uncles, relatives that are getting close to retirement and have very little to no savings as they retire, right? And having a strong reliance on Social Security and things like that to make ends meet. But this could have all been just completely avoided with
Right.
proper planning and savings.
Well, I think the biggest factor on your side is time. Like
Right.
if you start saving now, even if it's $10 a week, like over time you put it in an interest-bearing savings account, like it's going to get to where you want it to be.
Right.
You just have to take the step to start it and give it time.
Yeah, no, time is so important, and we're going to dive into all that. So, should we start by just talking about maybe when we talk about savings, how are we thinking about this, right? And how do we sort of digest this? And broadly speaking, I tend to put it in three categories, at least to start with.
Okay.
So I think first of all, you need to be planning for a rainy day fund.
Right.
The what everybody knows as the rainy day fund. And this is really just, it helps you cover smaller unexpected expenses. You might be dealing with car repairs or a new appliance or something like that you have to spend money on. Something that you weren't necessarily planning, but that you don't want to be caught by the surprise of that additional cost.
Right.
Because it may, especially nowadays, it may be an expensive new appliance, or it may be expensive auto repairs that you're dealing with. So, I think by having a good rainy day fund, it won't throw a wrench into your entire budget or even put you into debt, which is what you're trying to avoid.
It helps you
with
just
some
be
of this.
prepared.
That's right.
Yeah.
Yeah, so be prepared for a rainy day, right? I think the second one that I always think about is an emergency fund. So this is more for like an unforeseen event. The typical one that we think about is job loss, right? Or at least temporary job loss, or a delayed illness, or an accident or something like that costs you to be away from work, or something that is
Having your normal paycheck.
right, that you don't have your normal income stream, and so you're having to tap into these savings to cover yourself, to
Right.
protect yourself. So, some people call it the cushion, the emergency fund, however you want to call it, but something that ultimately gives you a good little cushion that can cover your main expenses, I would say, for at least a good 3 to 6 months, right? And probably more conservative, closer to 6 months. I've heard some people recommend closer to 6 to 12 months, and I know that would take a lot, but I think you should at minimum try to aim to have a 6-month cushion. I think that gives you a lot of time to figure some things out, heal, or whatever the case might be, depending on what your situation might look like. But 6 months of living expenses for basic necessities such as bills, groceries, transportation, childcare, whatever the case might be. But I think an emergency fund is incredibly important from a savings perspective.
Yeah, because I think then you're like, again, you're prepared. You're
Right.
ready for, whatever's going to happen.
Yeah.
And, we talked about it a little while ago, but it's almost like that's the hardest thing, right? It's just having that money sit there and like not using it or saying, oh, we'll just use a little bit of that. Or it's like the purpose is, to save it.
Yeah, I mean, and especially right now, right? Because the other thing that's happening around April is tax returns are being finished, right? People are getting their returns from the IRS. And think about it. How many times have you heard people say, oh, I'm just waiting for my tax refund because I'm about to, buy a new car.
I'm going on a trip, or I'm going
to trip. How many times do you actually hear people say, oh, I'm actually going to save this money?
It. Right.
Probably rarely.
Right.
And because the other piece is so tempting. But I think as we talk about, we've been growing up now that we have families and kids and just trying to keep up with it all. And I think it's sort of forced us to mature in our thought process a little bit more than maybe.
It's not so much the right now, but it's like the 6 months from now, the 2 years from now.
Yeah, and it's also fulfilling my responsibility as a parent, right? I got to plan. If something happens to me, I want to make sure my family's, taken care of and prepared and et cetera. So I think, as you're thinking about some of these things, like your tax refund, or as you're thinking about allocating your next paycheck, for example, think about these things. Think about, do you have a rainy day fund? Do you have an emergency fund? And again, I'm not saying you need to deprive yourself from the joys of life, right? Which kind of leads me to my third savings bucket, is have a savings bucket for the things that you want to do or the goals that you're trying to reach, right? So, like if you're trying to get married and you want to have a wedding, then start a savings account for these, again, whether it's short or long-term goals, right? It may be a wedding expense, it may be a new car, it may be, covering your child's education. I think if you can just incorporate a set amount that is going to the savings account, or, however you're distributing it, every month, every paycheck, et cetera, so until you hit your goal, and then have that trip, and then buy that car, and then at this point, there's been proper planning that's going into play. You're still managing your finances correctly. It's not a significant debt burden either, right? Because of course nowadays, if you want to buy a home, for example, you need to put at least 5-10% down.
Got to have that down payment.
So if the average price of a home right now in the Valley is, call it $250,000, and you're going to put 10% down, well, you're going to have to come up.
Change.
That's right. You're going to have to come up with $25,000 in cash, and not everybody has that amount of savings right now in their bank account, and so it really just kind of opens your eyes about the importance of savings and how real it can get. What's funny is, so the alternative is, let me go rent, right? Which is fine, but what's interesting to me is rents have gotten just as high.
Yeah, it's basically a mortgage payment.
It's basically a mortgage payment, and that's where I'm going at, right? So if you make the sacrifice, let's just say in this case, of saving for your down payment and going through that process, and I understand that it requires a lot of patience and discipline, et cetera, sure. But, then after that, you can afford your own mortgage, your own space. You build wealth, right, by also buying an asset that tends to appreciate in value over time, and you build wealth that way. But I can't tell you how many friends, relatives, et cetera, have said, no, I'm just going to continue to rent because I don't have money for the down payment. Well, but if you made some sacrifices, I think that you could get there, right?
Well, and I think you alluded to it right now, where it's people. I feel like people have a misunderstanding or misconception where it's either you don't save at all, or you save to the point of like you're depriving yourself from things, right? And so you have to find that happy medium that aligns with what your goals are. And I think that's a big step. A big first step is like, what is your goal? Like, write it on a piece of paper, put it on a sticky note, put it on a note on your phone. And that's going to help you, okay, what are some small sacrifices here and there that at some point will turn into that vacation, will turn into that home, will turn into that car, whatever it is you're wanting to accomplish, but without sort of taking that first step and saying, well, what is it that I'm wanting to save for? Whether it is your rainy day fund, or whether it is your emergency fund, or having, and I follow a lot of like financial influencers, I guess that's what they're called, on like Instagram and TikTok, and everybody sort of has their own way to go about it. And so, hey, if 3 months works best for you, perfect. If 6 months works best for you, if a set amount like that's kind of, start there and work backwards and say, with my personal situation, what can I do to then get to that point? And maybe it is something as simple as, not going out to get a coffee every day, because, hey, inflation is real.
Oh, yeah.
Coffee is expensive.
Oh, yeah, so expensive. Despite more, coffee stores opening up in our area, which is great. It's good to have variety, but
no, I appreciate a good cup of coffee.
Oh no, for sure. But you touched on something earlier that I think is by far the secret to all this, and it's autopiloting your savings, saving automatically, or just put it on autopilot, right? out of sight, out of mind,
Right.
you know, I think is basically the basic principle of that, right? What do we say in Spanish? Well, this is probably not the best analogy, but ojos que no ven, corazón que no siente. No, okay.
All
Probably not as relatable to this. But my point is, out of sight, out of mind. And I think if you can just, you know, sort of focus on, if you know, let's go through an exercise. Maybe this will help.
Okay.
So if you get your checking account, if you get your check from your employer, and it's direct deposited. I think most of us are now in direct deposit, and if not, you need to be.
Yeah, maybe ask that question.
Hopefully everyone's in direct deposit now, and hopefully at a TMB account, by the way.
There we go. Got our Texas checking account.
That's right. Yeah, thank you. So if the moment you get your direct deposit, and let's just say you're getting paid biweekly, depending on how you're more comfortable, you know, planning for your finances, let's just say on a weekly basis, you say, well, okay, well, this X amount, this X dollars are going to go to my retirement. Now, maybe it started before that, right? A lot of people have employer-sponsored, for example, retirement plans, like in a 401k.
Right.
And that might even start before you actually get your direct deposit because, you know.
It goes from that paycheck.
That's right.
Before it even, yeah.
Yeah, it gets deducted automatically out of your paycheck before you get that direct deposit into your bank account. And there's advantages to that, right? And I would say look at that first because your employer may match up to a certain percentage of what you're putting in. And that is just basically free money that everyone should be taking advantage. I can't tell you how many people ask about this and, you know, they don't know how much their employer matches, or they say, I only put, you know, X percentage. And I always ask, does that meet the threshold where your employer will fully match that amount?
Right.
They're like, no. And I'm like, but you're just leaving money on the table. Yeah, right. So I think at a minimum, I would strongly encourage everyone that does have an employer match program with their employer to at a minimum put the amount that your employer would fully match. It just makes so much economical sense.
Right. And if you don't know if they do or not, ask the question.
Yes.
You need to ask.
Talk to HR.
Right.
You know what's funny though is I think there's a lot of people that maybe are a little embarrassed, you know, to ask the question.
Right.
I've been here 4 years, 10 years. I don't think I've ever asked this, and I'm embarrassed to ask, you know, the head of HR that, you know, they're like, what do you mean you don't know? Or, you know, I feel judged by it.
Yeah.
Worst thing you can do.
I feel like the only dumb question you ask is the one that you don't ask.
That's right. Yes. And I think especially when it comes to money.
Right.
Hey, if you don't know, you don't know. That's fine. But start now. And
now
it's just
you know.
a very simple question. And I'm sure, you know, what's funny is I talked to our HR staff and
Shout out to our HR staff.
Shout out to our HR staff. And they'll be the first one to tell you, no, you need to be getting there.
Right.
You know, get to up to the amount that they match. And they almost strongly encourage you to do that during, you know, orientation or during our
onboarding and all that stuff.
Open season for benefits. So please, like if you're not doing that today, you must do that. It's just a no-brainer. And so okay, so let's just say you got your retirement piece covered. Now you could have a separate one. Obviously, that's totally optional, and depending on, you know, income and spending habits and all that you may still want to pursue that. There's annual limits that go into your retirement plans. You got to be mindful of that. But you know, typically I would say at least consider putting what they're going to match, and you know, up to the maximum annual limit that the IRS puts out there for every year for these retirement plans. And then just divide it by your paychecks. Right. So that's the first one that I would say. Just kind of automate that. A lot of people also have their insurance plan may be a high deductible insurance plan, and if that's the case, and if your employer also offers a health savings account,
there you go. Yeah.
That would be another thing that you would sort of take out before you get your direct deposit.
Right.
And there's a lot of great stuff happening actually with HSA accounts. They call them HSA accounts, health savings accounts. A lot of people don't know this, but you know, that account can be actually passed on generationally.
Okay.
And a lot of stuff is actually covered by your HSA account. So if you're unfamiliar with the HSA account and how it works, also talk to HR about it. Please don't,
Right.
don't be embarrassed, don't be shy. Just go out there, ask the questions. Now there's also new stuff that's coming out that if you the HSA account limits, I think first of all have gone up, but I also want to talk a little bit later about 529 plans, and then I'll come back to that. But HSA plan, again, just a great way of, in a way, it's like you're preparing for unexpected expenses, right? So maybe this is also a little bit already of the we talked about the emergency fund.
Mm-hmm.
In a way, your HSA fund, at least from a medical perspective, is kind of
that was one choice I made when my husband and I decided, like, we want to have kids. I was like, okay, well, doctor's visits. You're going once a month, every 2 weeks at some point.
Right.
And that really helped. And that was money that, again, it's set up automatically to deposit so much into my HSA account that at the end it was so helpful. It was so beneficial to our situation. And granted, I wish I would have learned about it a little earlier than I did, right? Because I think I only did like maybe the year before or the year of. But even now, that's just something that I continue to grow with my kids, right? And having them, my kids, my husband, doctor's visits, dentists, all the different kinds of doctors they got to go to, that it really was, at least for me, a peace of mind. And it was like, hey, we already have this set aside. We don't have to worry about dipping into our regular savings account, or even our, monthly paychecks, that sort of thing.
Right. And
really just goes back to the automation of it, because it just happens every time I get paid. It goes directly into there. And it's like, over time, it grows.
It grows, yes. And, and then what's interesting about that is that there's a lot of things covered under HSA. I'm starting to learn,
You can shop at Sephora with your HSA
Okay,
account.
so we got to talk about this a little bit, not too much, because all of a sudden I see that there's a charge because I get text messages every time I either save into my HSA account and also when there's been a withdrawal on my HSA
don't be calling
account.
anybody out on this podcast, right?
I'm going to try not to. I'm going to try to protect the innocent. But my wife, she all of I guess she's like taking care of herself, right? And I think some of those expenses, as she goes through those visits, whether it's like something like a facial or something, I don't know what she does most of the time, but she's like, hey, I might have just used your HSA account for this expense.
And she's being forward with you,
And I'm
like up
okay,
front.
well,
Like,
thank you for being honest.
I'm gonna call her because there's probably some other places that she can use it at.
Don't do that, please. But so a lot of it can be covered. And again, the tax advantage also associated with this is huge, right? Because it's obviously deducted prior to you getting your earnings, and so it's another huge benefit from that perspective. But again, also if your kid all of a sudden needs a medication, more importantly, or if you have a doctor's visit or whatever the case is, I went to the chiropractor the other day, paid with my HSA account.
Right, so, the co-pays and all that. Right.
So I think it's an incredible benefit again, and especially if your employer also does some sort of matching program or whatever the case might be, strongly consider that.
Just ask the question.
Yes, ask. Please talk to your HR staff. I think it's you'll learn a lot. So all that is just before you even get your direct deposit. So hopefully you've already done at least some of that, and that that you don't even have to worry about allocating those expenses because that's just
it's already being done.
It's already been done. Your employer took care of it. You just told them how much you wanted to allocate towards that. But then after that, then you start thinking about these other things. Okay, well, how much do I want to save for this trip I want to take, or how much do I want to take for I'm trying to save money for buying that house. So start kind of parceling it out every week, X percentage of that paycheck or X dollar amount.
Right.
And then that just sort of automates the whole process.
You don't got to think about it. It just happens. You don't have to say, oh, because it is a little bit harder. And I did that to myself for the longest time, where it's like, okay, every Friday I'm going to put a percentage of what I have left into a savings account. And even sitting there, and we could you could do it through our mobile app, but even just sitting there looking at it, I'm just like, every Friday it was difficult. It was hard. I'm like, okay, savings. So going out of my checking account into my savings. So I was like, I'm not even going to worry about that. And I just set it up automatically. So I don't think about it. I get an email on Friday morning when it's done. And I'm like, okay.
It's perfect.
Yes.
The other one that I had to start thinking about now is 529 educational plans, right? So, I have a 4-year-old and I have a 5-month-old, and I have a little bit of time, but that time goes by very, very quickly.
Right.
And again, you mentioned this earlier. Time is your biggest friend when it comes to savings, right? Because the power of compound interest, right? Where you earn interest on top of interest. So time is your best friend when it comes to savings. So the other thing that I've done in terms of automating is I started putting some money aside for both of my daughters for a 529 plan.
Okay.
And there's incredible tax benefits to that. That is another account that can also be passed on generationally, right? So, let's just assume my first child is, the ultimate scholar and has a full ride paid to wherever she wants to go to. Well, I can pass that on to her sister, for example, or another relative. The other thing also, and this is what I wanted to get at before, is there's now some changes with 529 plans that they can ultimately be rolled over into a Roth IRA in the event that you don't use that fund.
Right.
That is a huge advantage as well, right? So now not only are you planning for their education, but if for some reason that money goes unused, then you can just roll over and you have a retirement account that with some good savings. For an 18-year-old that's ready to go to school,
right.
Or let's just say graduates at whatever it is, 22 years old, it might have a good chunk of change sitting there. If they did nothing with that money and just waited until they're 65-year-old, they'd be pretty well off.
They'd be good.
Just because of time.
Right.
And so, again, the whole concept of this is just that by automatically deducting the money before it even hits your account, it can really help you to make the savings process much easier. Because at the end of the day, you can't miss, or more importantly, spend what you don't have.
Right. Oh, yeah.
Right.
And I think then that's that's the biggest thing. It's part of your monthly, routine, your budget, whatever you're setting up. Don't even consider that. That whether it's $10, whether it's $100, it goes straight into your savings account. And that's not something, like you said, that can be missed because it's not yours.
That's right. No, it's huge. I think you have to automate it, and you just got to, again, out of sight, out of mind. And I think it just goes such a long way in terms of planning and ensuring that you're consistent and disciplined with your approach.
Yeah, that discipline part is not easy.
That's right.
So we talked about saving automatically. We did touch a little bit on saving for the unexpected, but I think that goes back to your 3 buckets. So always saying, hey, you know what, this one bucket for saving for the unexpected, it's going to be, something as big, like you said, as maybe, not having your normal paycheck, or something as small as, hey, I'm going to, save money for, those car issues, or, the fact that maybe, you had a family member that needs some assistance or whatever that is. I mean, down here in the Valley, we're very much family oriented. And so I know that happens a lot. Extending your hand out to your family. And then the next one is saving for milestones, goals. I think that goes back to writing on that sticky note. What is it that you're wanting to do? Is it, owning your own car? Is it buying a house? Is it going on that vacation? Is it that pair of shoes that you want? So you just got to know what you're trying to work towards.
Right. And again, nowadays with again, we talked about how just convenient it is to shop if we're just not careful with really being very intentional about our approach.
Yeah.
Again, it can quickly spiral out of control.
I took a quiz on this, and I guess we can talk about it. Our Money Matters.
That's right.
Talk about it
yes.
a little bit.
Yes.
A financial wellness tool that we're going to be launching very soon on our website.
Yes.
It has you take a checkup, a quiz when you first log in. And I already knew this, but it kind of hurts a little bit to see it, official on a quiz. But I am an emotional spender.
Oh.
I'm somebody where if I have a good day, I'm like, okay, let's go to Target. If I'm having a bad day, hey, let's go to Target.
That's what I do with food, so no judging. But
there you go. Yes.
No, we definitely got to be mindful and take care,
so,
right?
like you said, being intentional about where I'm spending my money. And, I've gotten into the habit of at the end of every month, I pull a report of all my expenses from the prior month. And I really try to say, okay, what am I, being a little looser on? What do I need to, tighten up the structure a little bit on my budget? But more times than not, it's going to be those days where it was like a Saturday morning, and the girls were in a good mood. So like, hey, let's go walk around Target, or let's go out to dinner or something. And so really, like you said, being intentional about where you swipe your debit card and where you're spending your money and where the biggest chunks of it go to, because you may not even think about it in that perspective where it's like, I spend most of my money, at a coffee shop, or I spend most of my money at Target. And it's like, what am I even buying?
Yeah, no, I think especially when you're getting no value
Right.
of wherever that money is going,
Right.
right? It's one thing to, put money into buying a house, because at least you're buying an asset that
Right.
will appreciate in value, and that you can leverage later. You can build wealth over time through that asset. But when it's going for expenses that you won't see any value out of, I think you have to be extra deliberate and extra mindful of, okay, what am I spending my money on?
Well, and those are the things that are not going to get you that instant gratification. I know we talk a lot about that too, because it's like, okay, well, I'm putting money down for a house. Great, I get a house, but it's going to take me 2-3 years to get there.
Right.
And it's like people want stuff now. People
Right.
want it now.
Yes, and again, the discipline piece. Like I talk about this topic with my family sometimes, right, and friends and such. And I don't know why, everybody assumes that they're going to die tomorrow. Like it's like, pues pa qué si me voy a morir? Like I feel like that comes up way too often,
Right.
and I'm like, hold on. And so I think, again, just be just practical
Right.
about this, and I think if you think about it like that, I don't think it's a smart way of looking at how you're going to plan for your life and plan for your future. And so I think be a good planner when it comes to some of this stuff.
Right.
And I understand that that's going to involve sacrifices, 100%. But don't jump to the conclusion that you're going to die tomorrow just because you don't want to save.
Right.
Yeah.
I know they think it's too late to save or something, but it never is. It never is.
That's right.
So, the next topic is something that was kind of new to me, and that is paying down debt is saving.
Oh, okay.
And so, I mean, that one, we all have, our credit cards, we all have and I guess when we say that, I from my perspective, I would say not the house, right? That's going to be something that is going to be with you for a long time.
Yeah.
So your focuses should be the Sephora credit card, the Best Buy credit card,
Right.
my regular credit card, the things that I put on there for big expenses. But, and nowadays, it was different, during the height of COVID,
Yeah.
but interest rates on these cards
Right.
and the interest that you're paying, it's almost like half of your payment goes to principal and half of it goes to just the interest.
Right.
And so, a $10,000 credit card is, you're paying so much more on top of that just with the interest.
Right. So I have a little secret to that. I guess I must have been like 18 years old, and I worked for this company, and we focused on debt consolidation.
Okay.
And one of the things that we kind of took pride on was we would come up with a plan for you, like a written plan, and give you the amount of time that it would take for us to help you get out of debt. Right. It was I think pretty cool and rewarding work, because we'd actually come up with a plan. Now, out of that plan, how many people followed through?
Again, the discipline
piece. But here was the beauty, and it was a very simple concept, but this is what it looked like. So let's just say right now you have a mortgage payment, and you have your loan at 2% fixed because you took advantage when rates were low. You have a car payment now, but you got your car payment afterwards. So then you have a car payment now, and you have a rate at 7%. But just say you're paying $1,500 for your mortgage, you're paying $700 for a car, let's just say, and you have 2 credit cards. One of them is a very low rate credit card, probably one here at Texas National Bank, and you have a whatever 12% rate, and then the other one is a 24% rate credit card. So this is the concept. So let's just say you're used to paying $1,500 for your mortgage. You're used to paying $700. I'm going to try to keep up with the math here. So Danny, maybe you can help us out. For your credit card one, you're paying $100, and credit card two, you're paying $200. So that is $2,500, right? In total monthly payments. Hopefully I did that math right.
Should we get a pen and paper?
So again, the idea is simple. If you're used to today paying $2,500 towards expenses, right? So the first thing you want to do is just tackle the loan with the highest rate, or your debt instrument with the highest rate. So let's just say you go after that credit card that you owe whatever, $3,000, and you have a 24% rate. So that's the one that you most want to aggressively tackle first, right? So let's just say that you're used to paying $2,500, and you can, you might be able to spend an extra $100 to tackle the debt on that first credit card quicker, right? So the idea is, let's focus on paying off that credit. Keep maybe if you have to minimum payments on the other ones, but let's just focus on paying that credit card first, okay? Then we're going to pay that off. Now, we're used to paying $2,500 anyways, right? So let's just continue to apply $2,500 for the debt. But now we're going to start tackling that second credit card with a lower rate, but still higher rate than maybe your car, right? So now we're going to focus on paying that one very aggressively. You're going to pay off that credit card. And then you're still used to paying $2,500, right? So we're going to continue to apply the savings that we've had now on credit card 1 and 2, right? So that's $500 between those two, I think is what we said. So we're going to pay an extra $500 a month towards your car note. So your car note is now going to be, you're going to pay $1,200 towards your car note. And I know that sounds like a lot of money.
Yeah.
But you're going to...
But you're already paying all that separately.
Yeah, you're going to be... Exactly. You were used to paying that debt anyways, right? And so now you can start tackling that debt much quicker. And by paying $1,200 instead of a $700 car payment. Think about the principal reduction that you're giving every single month just by doing that.
Right.
And then we finish your car payment. Well, then now you have, what do we say? An extra $1,000 a month to pay into, $700. Yeah, $1,200. There you go. An extra $1,200 to pay into your mortgage payment of $1,500. So that would significantly cut on your amortization as well. And then, if at that point you say, you know what, maybe I can continue to keep up with, maybe I can pay only half of that and start some savings, whatever you want to do, right? But the strategy is just tackle the debt with the highest rates, right? So you're not paying interest, you're not paying so much in interest.
Yeah.
And then use what you're accustomed to continue to tackle debt more aggressively, accelerating principal reduction,
right?
And therefore getting out of that debt quicker and accelerating your ability to save.
On the other side.
On the other side.
And then that's a good perspective, because if you're already used to paying all that a month, just allocate it in a more efficient way.
Yeah. Unfortunately, what happens is you're this close to paying your car, and then people go out and take out another car, right? And so when your car may be only 3 years old, 4 years old, right? But you got to have that new Tesla.
Cybertruck?
The Cybertruck. So I think, be prudent with how you do that. But that's a great strategy towards paying down debt for ultimate savings.
Right.
And there's other strategies as well, right? You can refinance your debt, for example. One of the things that I did, during COVID, right after COVID, is I did a cash out refinance. I had my mortgage at maybe about 4%, and I saw that rates had dropped down very, very significantly. So, but I also wanted to remodel my home. It needed a little lift up, and so we took out a little bit of cash out of my mortgage. And but what I did was, once I termed out my debt, I termed it out over a shorter period. Instead of 30 years, I decided to go 15 years.
Okay.
And also at a 2% rate. And what was interesting to me is that my monthly payment was almost the same, just by the interest rate savings.
Right.
Even though I had cut my amortization virtually in half, and obviously reduced my rate. So that's where the savings were. And taking out money is my point. Yeah, I was taking out cash out of my loan, and then on top of that, also cut my amortization in half. But still, because of the rates, the rate reduction from 4 to 2%,
it makes a big difference.
Payment was almost
it makes
the same.
A big difference, and you don't think about that because you're like, well, that's just part of my payment.
Right.
That's just something I have to pay, each month so I don't get behind.
Yeah. Now,
But
over time, it's gone up a little bit more now because of
unfortunately,
taxes and insurance, but
Right.
not because of my mortgage payment.
right, the actual
and,
base payment of your house, but then everything else that comes along with it.
Right, and that other part you can't control much. But I think so. That's another great strategy, right? Is refinancing, taking opportunities like that. I've heard people taking out a home equity line of credit, for example, and using that as their main operating account to try to tackle their mortgage debt and other debt much quicker.
Oh, wow.
It's a great strategy. I've heard some people talk about it recently. It makes total sense. It's just, but it could, if you're not disciplined with that, that can get you into trouble. So,
And that's what I'm saying. It always goes back to have a plan, but stick to the plan.
and also like know yourself well enough, right?
Right.
So, like for example, this
Be
HELOC
realistic
strategy.
about what you're trying to
Yeah,
do.
when I heard about this HELOC strategy, I had a little bit of mixed feelings because on one part, my finance background was like, yeah, that makes sense. I can see that working out. But I was like, but it's also very dangerous because for the perhaps undisciplined spender, I mean, you have a line of credit with a pretty big balance there that's available for you to just spend money.
Right, just burning a hole in your pocket.
That's
You're
right.
like, I just need to use it. But I think that also kind of circles back to why we named our program Financial Wellness, because it's just like working out. If I want to lose so much weight, I want to gain so much muscle, whatever it is, it's a constant journey. Like you're always, every day, the decisions you make are to either bring you closer to your goal or going to move you farther away. It's like the fact that if you have something, healthy for lunch versus having a Whataburger, right? Is that going to put you in the right path to what you want to accomplish, or is it going to put you in, on the wrong path?
Right.
And so it's a constant, every day got to wake up and make those decisions with all this in mind.
Yeah. No, 100% agree. And it's one thing to just talk about the concepts, right? So we always talk about financial literacy as understanding the concepts, having the knowledge now of what are the different concepts.
Right.
But you're right, it's taking active steps towards that. Now that you have that knowledge, taking active steps and having the confidence, having the access to be able to take the next steps, I think that's where the value is. So, more than just having financial literacy, we really want to focus on your financial well-being, right? So that's why we call our initiative Financial Wellness, right? Because we ultimately were wanting to make sure that people were taking proactive steps to try to address the needs, right? But also apply the technical knowledge that they've built through financial literacy awareness.
Right. You got the education and got to use it.
That's right.
I got to use the skill.
That's right. But you made a really good plug right now for our new tool, the Our Money Matters tool. I think it's so exciting. You talked about being an emotional
spender.
Emotional spender. I did my financial checkup, and I can't remember where I landed on that end. I got to go back and look at it. I'm probably due for an update on my financial checkup. But I mean, just to tell folks more about it,
Sure.
I mean, it's a great tool because it guides you, first of all, through a list of questions that are essentially identifying your financial stressors, right? And where you stand on that and where you want your focus on. But then it interprets the results of that, and then it gives you recommendations of different
like classes,
webinars,
courses, articles
et
to
cetera.
read,
Yeah, that you can take to address that knowledge gap. And I mean, it's first of all, it's a free tool that everybody can just go into our website and use it. And I think the amount of knowledge that's in the tool that's to be shared and to be gained from this financial literacy tool is incredibly powerful. So, really, really encourage our entire community to get out there and check it out.
Yeah,
and
it's coming soon. We'll let y'all know when we put it out there, but it'll be on our website.
Yeah, I'm really looking forward to it. I think it's going to be incredibly exciting.
Yeah. So I guess that brings us to kind of our last topic, and that is saving as a family, which is my favorite thing because, I mean, like we talked about, now I have, I got a husband, I got 2 kids, and so finding things to do together. And I mean, I was raised by a banker. I got banking in my family. And so for me, it was, a concept that was always front of mind. It's like, yeah, you're making your paycheck, you're doing all these things right now, but what are you doing for next month or next year or 10 years from now, or like when you're ready to retire, which seems farther and farther away, but that's another conversation. And so being able to, have resources like, I'm going to pull from my experience here at the bank, we have our RICO checking account, our RICO savings account.
Right.
And so it's something as simple as, $5, $10, like just understanding that concept and knowing that it's not something to be afraid of, but something to embrace. I think it's something that anybody can do at any level, at any rate. We have our regular savings account, we have our commercial savings account, so we know there's business out there that they also need that little comfy cushion. They have things that come up too. And so saving at any age is important, at any stage, for any purpose. Yeah. We have the resources.
Right. No, I agree. I opened up a RICO account as well for my daughter, and I think it's exciting because I think the incentive behind it, right, is all about starting to teach them at a very young age,
right, how
to create that discipline, right? Mm-hmm. And so it's really neat because you get to spin the wheel and,
Yeah, a little plug for our RICO wheel for
please.
When they so some cool perks that come with our RICO savings account. We have a birthday wheel, so in the mail they'll get a birthday card, addressed to them, and they get to come in, bring the voucher, spin the wheel, and there's amounts on there from $1 to $10, and so whatever it lands on, we'll add that into their savings account. And then if they come make deposits, we have these cool prizes that they get to pick from. Behind the teller line, they'll come in, talk to one of our tellers, and they get to pick. We got like rubber ducks, we have little beach balls, we got cool cups, we have rulers. We have a lot of fun things, and because it is a fun thing.
Yeah, and you gotta, again, for now, obviously they're they might be a little smaller, but the whole concept of put some money into your saving account and there's a reward coming.
Right.
I think that, and if maybe there's some psychology tied to that, but I think it's incredibly important to teach these principles at a very young age. I think especially because maybe some of us didn't have that experience, right? Like I think a lot of, you mentioned your background is your parents, they were involved in banking, they were familiar with it, that's great. And I'm going to be able to do that now for my daughters, but maybe I didn't have that, or maybe so whoever's listening today might not have that same background, right? And so, by having the knowledge now, it's a great time to start teaching your kids about again these fundamentals around financial literacy and overall financial wellness, and of course savings being an important one. And then also just think about the different of how we approach different things. So like, for example, one of the things that we started doing is I think my kids are probably spoiled enough by their aunts and uncles.
Right.
And they get
just
enough
naturally.
gifts. There's enough toys in the house already, right? Or, sometimes we just have friends that, hey, my kid's too old for this now. Here's a bunch of different toys, right? And so I don't know that they need more toys, right? So one of the things that we started doing is, so for example, in her birthday party, we said, all types of gifts are welcome if you feel like it, if that's something you want to do. In lieu of gifts, if you're comfortable, we prefer that you maybe donate to her 529 plan.
Yes.
Or put some money into her savings account.
Right.
And I've seen a couple other parents start doing that. Some of my good buddies I've seen their invitations say that. It's not the majority. It's the minority. It's a few friends of mine that I see their kids' invitation, and I kind of have like a proud moment, like, wow, that's great that they're thinking about this.
Your education is spreading,
right? And
I think that's another big pillar of what we do. Why we do what we do, because it is filling in that gap.
Right.
We talk a lot about the valley and then I think a big piece of that is the education, because we are coming into this new generation where kids are just savvier.
Right.
Like they're just, from age of like 2, they're just smarter. Right. Like they grasp onto different concepts. And so, they're just expected to already sort of have a leg up. Like, in middle school and high school, I mean, even, my youngest sister, who were 8 years apart, she was taking classes in high school that I didn't take till college.
Yeah.
And so I just know that they're just getting more advanced.
Oh, yeah.
And so I think having these resources for them to then allow them to have a leg up, even if maybe their parents didn't teach them those skills. Well, it's okay, now it's your turn. Now you're at this moment where you can make these small little changes, and you're just going to be leaps and bounds, more prepared.
Yeah. This reminds me a little bit about Texas National Bank. Also has an affiliated nonprofit foundation called the TMB Foundation. Little plug in there. And we just went through the exercise, or really evaluating our group of candidates that came in. We decided to do a scholarship. Let me give some context. We, as a foundation, said we want to focus on education. It's an important need in our community. We see education as the great equalizer. So we decided to do some scholarships. And so we're going through the selection process by, evaluating a bunch of different things. But among them also, we asked the candidates to do an essay. Some of them also came in and did an interview, so we got to meet a lot of the candidates. So two main takeaways from that. I think, first of all, you're right. The students that we interviewed were just incredibly impressive. You can tell that. I'm just happy that 18-year-old Ray is not competing against these
for sure
against these group of kids, because my God, they were so impressive. So you're right. I think the competition is real. And then the second thing that I noticed was, as we start talking about education and their plans, and we start asking them, hey, where do you want to go to school? And some of them, actually the majority of them, had great aspirations for school.
They all have these goals.
Yeah. And they're like, well, between, let's just say UT and UTRGV, and both great schools, right? And when I asked them, some of them might say, well, my preference in this case would be to go, let's just say go to UT, right? Because they maybe have a better program on something, whatever the case is. Or the same thing would happen sometimes with A&M. But what they said, but ultimately I think I'm going to end up at UTRGV. And I would ask why. And it says, well, I can't afford to go to those type of schools, right? And or cover living expenses by going to that particular school. Even if I get my tuition somewhat paid for, I may not have sufficient to cover living expenses and room and boarding and just all the expenses of being at UT.
Right.
So I'm going to stay local. And that's not a knock on UTRGV. I am a UTPA graduate. That's what UTRGV was before what it is today. So incredibly proud of our local university. But my bigger point there is that that you could see that, maybe because of lack of proper planning for educational plans and goals, et cetera, as we think about saving as a family, especially saving for education, you could see there that it was literally life-changing decisions, right? Maybe they weren't going to go into the major or the field that they wanted to go to. They were going to have to, make sacrifices. So, look, regardless, ultimately, I think they're going to do well, and I think we're incredibly proud that we're going to be able to support some of them with some scholarships. Yeah. So, really excited about that. But just to go back to the topic of why planning as a family for saving is incredibly important.
Yeah, and it's just something that y'all have the same mindset on. And so my husband and I struggle with this a lot because he, I joke, but not really. I wasn't even out of the hospital with my girls, and I was already like, okay, I got to open their check savings accounts. I have to be ready to go because, I know that the burden that it can put on just anybody when they're really trying to set up, their kids for success and for having them to be prepared. And so we have these colorful discussions about, the planning, and really he doesn't have too many opinions, but, I was like, yeah, we have to save for their college and what they want to do. And he's like, but what if they don't want to go to college? And I said, well, that's not really an option. I don't know, just joking. But, when whatever they want to do, it's like we have to start now for them to be ready.
Right.
And even us doing the math, right? And it's like, now they're 19 months, but, I started 19 months ago, and it's like if you put so much in their account every month for 18 years, okay.
Yeah.
They're, even if it's not going to be everything, it's like they're going to be just that much more set up for whatever they want to do. If they want to go to college, if they want to go to, some kind of there's a vocational school where you learn a skill, that's up to them, whatever they want to do. But I want to do what I can to make sure that they're at least halfway prepared for for that.
Right. And then, again, worst case scenario, or if for some reason they get their education paid for through academics or whatever the other
Right.
case might be, you can always roll it over into an IRA.
There
And there
you
you go.
go.
You're planning for their retirement now too.
Yeah.
So no, 100%. And then again, sometimes let's just even by just starting with the basics, what happened to the days where you used to get a little piggy bank and you used to put, quarters. I guess it's not existing anymore because
Yeah.
everything's digital wallets. But I think even we can just teach our kids that, right?
Yeah.
Hey, you put money into this little.
Well, and that's such an interesting point because nowadays there's no visual of like your savings.
Right.
I mean, yeah, you have your bank account, you can see the amount, but it was very satisfying to have that little piggy bank and you would put your birthday money in there or your coins or whatever, and you would see it kind of filled up. And that's a visual that I have in my brain because when I was growing up, my dad had one of those Coke bottle piggy banks, and it would always, he would always take out whatever change he had in his pocket because back then we used cash, and so he would say, hey, here, go put it in the Coke bottle, and they had it in their closet, and it's just something that always stuck with me. And it's something as even as simple as that. And eventually you fill the Coke bottle up, you bring it to the bank. We have coin machines here. So bring your coins,
That's right.
We'll run it through the machine. They can see how it is. But even just something, like that, or print out a piece of paper, put it on the wall and color in the boxes or the squares as they, having that visual of their hard work.
Right.
And you talk about, they come here and they get a prize, and the mentality of having a reward, well, they're 2, 3, so the reward is this, cool cup. But 20, 25 years from now, the reward is a house.
Yeah.
Like it's kind of the same thing. It just, the price changes.
Yeah. And, I was listening to this guy the other day, and I think he even uses sort of getting things done around the house, right? Or chores related activities, right? To let's just say pay his kids their weekly allowance or
Right.
whatever it is. And it was funny. I actually really like his take. He's like, look, chores and all that are standard. I'm not paying them for that. That's just cost of living here,
Right.
Put
away your laundry.
I'm a little old school, so I kind of like the tough love.
Yeah.
But he said, however, if he went above and beyond, and let's just say, he did, maybe cut the grass, or he washed my car, or did something aside from his standard chores, then I'm happy to pay him something.
Yeah.
And I think there's other lessons tied to that, right? Being compensated for work and would you contribute essentially to society, right? And you can receive earnings from that.
Right.
So I think there's great learnings in that process as well that you can ultimately bring back to, okay, now that you have some income, hey, let's focus on saving some of this.
Yeah, for sure. We covered a lot of topics
Oh,
today
great.
for our first, our inaugural episode, I guess, of the...
Incredibly exciting.
There we go, Banking Friendly. And it just all kind of worked with Financial Literacy Month. Just a lot of really good topics to, like we said, take you back to the basics. Take
Yeah.
you back to, well, where do I start?
Right.
Right? And I think this is such a good foundation for anything that you want to do.
Yeah, and again, the timing of this is so opportune right now. Like, again, for all of the members of our community, if you're listening today, I think, as you start thinking about getting your tax refund, as you start thinking about, just the different things that may be going on in your life today, maybe you're planning to buy the next house, maybe...
Or your first house.
Yeah, or your first house, or maybe, you're trying to buy your first car, or you're trying to breathe a little bit better because you have maybe more debt than you're comfortable with.
Right.
And I mean, just take the next step. Break it down into some of the categories that we talked today and just get started. And you're like, well, Ray, I may not have a lot to start with, but just start with something.
Right.
And then develop the habit, develop the discipline. I could tell you, for example, that I've always somewhat worked out every throughout my lifetime. I would say since I was in high school, always in some shape or form. I've always worked out. But if I'm honest, it's not until the last 2-3 years that I've made it a daily habit.
Right.
And what it did, it was just a discipline thing. For me, this is going to be maybe an obvious thing, but it's a sacrifice again. I decided that the only way that I was going to be able to work out consistently now that I have a family is I needed to get up early in the morning while everyone's asleep, and that's a sacrifice.
Right.
It's not fun. I would rather sleep, believe me, every single time. but I get up at 4:45 or so, and I have a quick hour workout, and my kids are not awake until 6:30 or something like that before I get them ready to school. So that is how I started a really consistent, healthy habit, and I was disciplined about it, and I've now consistently worked out for a while,
Right.
which is great.
Well, I can't relate to that, but good on you.
Well, this is in no way to toot my own horn, by the way. Believe me, it's a sacrifice every day. But the where I'm going with it is the same thing applies to your savings. I think it's going to involve some discipline, and it's going to involve sacrifices.
Hard choices, hard decisions.
But by the time you know it, it's so rewarding, right? Because you might start seeing your 401k, all of a sudden creeping up.
Grow,
and, oh my God, I have more savings than I've ever had in my life. This is great. And that's what we ultimately want to get to. And then, we all know this. This is a stat that I think has always been the stat as far as I can recall. But we know that finances is the number one stressors in Americans' lives today.
Right.
And the number one reason why there's issues around families and communities. And so if we can somewhat alleviate this, imagine all the good that'll come out of it as well.
Yeah, because some people don't even want to have the conversation. Like, they don't even want to talk about it because they're like, we're just going to, not agree or not be on the same page or whatever it is. And so I completely agree with that.
Yeah, and I think, let's put our egos aside for a moment. Let's be vulnerable for a quick second here. It's not that big of a deal, and let's just ask the questions. And I can tell you, there's a lot of us that, even that we're working in banking, finance, et cetera, that don't have it all figured out. I can tell you I certainly don't. But this is my journey. I'm starting on it, and I'm working my way there. I didn't start here, and so it's just we got to start somewhere, and you just got to make good decisions, create good habits, and
just take that first step.
That's right.
Yeah. Well, we hope everyone out there listening learned something new.
Yeah, I hope
today. Something that'll help them. If y'all start writing down your goals, working on your budgets, your savings plan. If any of these things work for you, or spark your interest in starting on this, let us know. We're here for the education part of it. We're here for helping our community, bettering our community here in the Valley. And I think that if we can impact 1-2 people, I think that's a great start, and it's something that we're dedicated to, we're committed to. So we have lots of things that we're going to talk about, coming up in our next episode. So make sure to continue to tune in, listen up for information on our Money Matters platform. That's something exciting that we're
soon.
Launching. Yes, coming very soon. This month.
This month.
Yeah,
yes.
this month here in April. But Ray, great conversation. Lots of good topics.
Yeah, I enjoyed talking to you today. Thank you so much.
To all you listening out there, continue to tune in, continue to stay updated, and we're here just to make banking friendly.
Yeah, that's right. That's what it's all about. And so, amigos, gracias. Thank you all. And we'll check back with you soon.
Yeah. Have a great rest of your day.
Yeah, likewise.